you have what's called IDCs or intangible drilling cost. That's massive as far as tax write-off. You can take up to 70 to 80% of the entire investment as a write-off in the first year.
Welcome to Alt Investing Made Easy, where we explore the complex world of alternative assets. I'm Roland, a securities attorney, investment advisor, and your co-host.
And I'm Sarah, an investment advisor and corporate attorney, and your other co-host. We'll guide you through real estate, private equity, and more, making complex topics accessible.
Tune in for insights that empower your financial journey.
Let's make alt investing easy, one episode at a time. Welcome everyone to Alt Investing Made Easy. Today our topic will be interesting for investors interested in oil and gas investments and everyone else who wants to know more about this class of alternative investments. We're joined by Jace Graham of Rising Phoenix Capital. He's a longtime oil man and investor and a promoter of oil and gas alternative investments. Roland, do you want to introduce Jace further?
Yeah, Jace, it's great to have you here with us today.
Honored to be on the call.
Jace is a new friend, actually saw the podcast and he and his team reached out, and we're excited to have him on as a guest today. Investments in oil and gas are classified at law as real estate, so they for sure fall into the category of alternative investments. Jace's investments that he offers through Rising Phoenix Capital or 506C deals include 506C deals. So that means that we can use general solicitation advertising. We can use this podcast as a platform to tell people about these investment opportunities. And we'll for sure include in the notes information about how to find out more about the investment opportunities that Jace is going to be discussing today. We give this kind of standard disclaimer that we can't make any investment recommendations without a specific relationship with any one of our audience members. So this is really for informational and educational purposes only. The reason why we can't make a recommendation isn't because we don't believe in Jace, but it's because we don't know necessarily without that relationship in place what your portfolio looks like. And, we have to talk about asset allocation and make sure that you have an appropriately balanced portfolio considering your level of risk tolerance. So again, this alternative investment space that we're talking about, it's more of the risk portion of your portfolio. Once we did create an investment advisory relationship, maybe we could recommend this, but in any event, we're here to learn more about what these investments are. And I think Jace is going to be a great person to tell us more about the investment opportunities here in oil and gas and real estate.
So Jace, you want to tell us who you are and about yourself, and then maybe more about Rising Phoenix Capital?
Absolutely. Well, guys, first and foremost, really appreciate being on the podcast. Love speaking to investors that are looking in the alternative investment space. Think it's a great way to diversify a portfolio and find some really unique type of assets that you can directly invest in. So quick backstory on me. Sarah, you kind of alluded to it. I'm a fourth generation oil and gas guy. Grew up in and around the business. My old man was a old school operator. I don't know if you guys remember the show Dallas, but he was the real deal J.R. Ewing on steroids. But I got to learn from him. Grew up in the Dallas-Fort Worth area. Went to college up in the Northeast at Cornell University. When I got back, I did a little stint in the restaurant business at a phenomenal restaurant called Houston's, which is now Hillstone, where I learned systems and process. I mean, they run that restaurant better than any of them out there. And I apply a lot of the stuff that I learned from that restaurant and how we run our day-to-day of our business now. So I looked at jumping in the oil and gas industry probably about 2 or 3 years after I was in that restaurant. My father came to me and wanted to see if one of his sons were interested in the business. And I really wasn't familiar with, how everything went down. I knew I knew how wells were getting drilled and whatnot. It's just growing up in and around it, but got a job as an independent landman. So I'd go out and negotiate oil and gas leases and run title back to patent. Back from the first president that deeded the first land back in the 1800s, chaining that title all the way from that point to current owner to see who the mineral owners were. Did that up in Northeast Colorado for about 18 months. Really learned a ton about the industry. Spent a little time down in East Texas doing more complicated title, and a little stint up in Oklahoma before I partnered up with my father at Palo Petroleum, where we really started doing a lot of oil and gas mineral buying in the Barnett Shale, which is just right outside Dallas-Fort Worth. We were doing drilling deals where we were leasing areas and then participating in drilling deals with operators. We've done direct drilling deals, so I've raised capital and been on well sites and on rigs and reporting back as the company man back to our investors. So I've seen all kind of facets of what we call upstream oil and gas, which is where really the tire hits the road from the drilling and completion side of the equation. So fast forward to 2016, my father was kind of winding down into retirement. My brother was coming in, wanted to take over our family company, and I started Rising Phoenix with a focus on real estate, investing. We do private mortgages, we do hard money lending, we do real estate, investing, land development, and also our backbone is in oil and gas, as you can imagine. So we started doing a series of 506C offerings, Reg D 506C accredited investor offerings to basically our friends and family in the Dallas-Fort Worth area. That's since grown. We now have about 35 million of assets under management. So we're not some huge private equity company that's trying to put, 500 million to work. We're really heavy into the ground game. We've got really good sales teams that are picking up the phones, talking to mineral owners throughout the country, and really trying to focus on where we buy and how we buy as close to, the source as possible to be able to bring that value add back to our investor base. So here we are today. It's 2024 going into 2025. We've got three distinct verticals at Rising Phoenix. Rising Phoenix Capital is kind of our capital raising arm. We got Rising Phoenix Real Estate, where we do a lot of real estate acquisitions and the lending and all that. And then, of course, Rising Phoenix Royalties, which is really focused on the acquisition and disposition of oil and gas minerals throughout the country, but with a focus right now in the Permian Basin, where there's just a ton of activity from really good operators.
Hey, Jace, this is the first time we've really talked about oil and gas on our show here. And I think one thing that would be really interesting, I've learned more about this and I haven't really fully appreciated it, but how drilling technology has developed over the last maybe 20 to 30 years. You can give the timeline better than me, but really has changed the risk profile or kind of the risks that I think historically have been associated with oil and gas drilling.
Yeah, you're right, Ron. I mean, the development of the horizontal shale development and drilling is really allowed the United States to become energy independent. I mean, you can say what you want about fossil fuels, but the way we live, the consumption of energy from electricity to, natural gas to oil to gasoline, all those things that we have, in America that so a lot of times we don't even, really pay that much attention to, comes from the ability of these operators to be able to horizontally produce in these shale plays. The shale plays have been around for billions of years. So there's no doubt about it, right? But to really figure out how to, these are very tight plays that if you were drilling vertically down and trying to stimulate or frack around them, we're only getting a certain amount. And it really didn't make sense based on the drilling cost. But if you're able to drill horizontally all the way through, that would have taken 10, sometimes 20 wells to drill vertically and get the same results out of one well. It really has allowed us to become energy independent and the top producer of oil in the world. And so obviously, we're a big proponent of oil and natural gas. It's not going anywhere anytime soon, just with the infrastructure we have in place. And we can definitely talk more about that.
Something that I found interesting from what you just said, that being here in Texas, we think, oh, oil and gas is a Texas kind of a thing. But just from your experience and also what you're saying about part of what you focus on as a business in terms of finding mineral rights that might be interesting around the country, that's, I think, an interesting point just to note because we have investors from around the country invest in deals all over the country. And it actually sounds like oil and gas or minerals as an alternative asset class is something that's viable around the country also. It's not state dependent on Texas only or Louisiana. And just, I think that's always something interesting to think about. I wouldn't have thought about it otherwise.
That would be an interesting thing to ask, Jace. What is the breakdown? Like, what percentage of the oil market does Texas represent? Colorado? I would bet, not knowing this, Texas is at top, probably the top oil producing state.
Texas is by far. Texas, produces, just the Permian alone, but Texas also has the Barnett Shale, has the Eagle Ford Shale kind of in the south, and even the Haynesville Shale over to the east, on top of all the older conventional vertical drilling. But Texas definitely leads. I mean, Alaska's up there. Okay, so there's no doubt about that. We kind of forget about that state way up there. It produces quite a bit of oil. But there's deposits all throughout our nation. The Northeast has got the Marcellus Shale, a lot of natural gas up there. The Colorado's got the DJ Basin. The West Coast in California has quite a bit of oil and natural gas production, believe it or not. And so it's in almost every state. Some more focused than others, but I think what you really got to think about is just think about the amount of jobs it creates. Think about all of these, the oil and natural gas is taxed. Of all the tax revenue dollars that are generated from this industry, they go back into the community and into the areas where it's produced from.
Yeah, you brought up an important point too, and the tax advantages of the oil and gas investing. At a high level, I mean, we can't give people tax advice, but I'm sure your investors ask all the time, or you have sort of a response or quick description that you can give of the tax advantages of investing in oil and gas.
Yeah, no, absolutely. I mean, there's three main areas that there's tax advantages on owning oil and gas mineral rights. You get what's called a 15% depletion allowance in perpetuity. That's forever. So meaning that if you receive $10,000 in royalty income, you're paying taxes on $8,500 of that. Okay, so that's just kind of basic. It's still a nice little bump. When you look at actual drilling deals, which is one of our strategies we'll talk about, you have what's called IDCs or intangible drilling cost. That's massive as far as tax write-off. You can take up to 70 to 80% of the entire investment as a write-off in the first year. So a lot of people look at that as just a way to just offset taxes with the upside potential of a really good return. A little riskier deals. You're investing in oil and gas wells, but there's massive tax savings there. And the third way is through 1031 exchange. So you can do a tax deferred. You could sell real estate and do a 1031 exchange tax deferred into oil and gas minerals. And we've got quite a few investors that do that.
Yeah, the deals that we've looked at recently are structured as general partnership interests that are convertible into limited partnership interests after the well has been completed. But there's a specific passive loss limitation rule that applies to the general partnership interest. And so we've been learning more about it, and we want to get to a place where we're really conversant in being able to help people structure those types of offerings for our clients.
Absolutely.
So just continuing, Jace, one of the topics that we had set out to discuss was maybe how we can, or the topic of diversifying your portfolio with energy and other, real estate, energy, and alternative investments, but maybe focusing on energy here. Also, maybe discussing, I think I remember discussing this with somebody recently, that we talk about the oil and gas industry, but really now maybe the energy industry is more appropriate or more comprehensive. So I'd be interested to hear your view on that. And just in general, like there's some tax benefits here, but in your experience with working with investors, what is the usefulness here for portfolio diversification?
Yeah, no, great question. I mean, that's That's what we're here to talk about. I mean, investors can invest into oil and gas in various ways. Obviously, you can invest in ExxonMobil stock. There are publicly traded royalty trusts that you can invest in on the S&P 500 or the New York Stock Exchange. You can also do commodity futures, which is a little higher risk. I mean, you got to know that stuff, right? And there's some master limited partnerships that focus more on the pipeline side, what we call midstream. Again, all that's like you can do that in the public markets. What I want to talk about and what we do is where we're directly investing actually in the minerals and royalties, and our investors are equity partners in those acquisitions. And so we've got three strategies at Rising Phoenix Capital. The first strategy is what we're going to call our bond debt strategy, all right, where the minerals and royalties that we're buying are the secured asset as the collateral. And so if investors want just a flat coupon, say I want to put $100,000 in for a year, there's a 9% just return that comes with that. And then it matures and you get your 100,000 back. If you want to do 2 years, 10%, 3 years, 11%. So if you just want just a flat, almost like a preferred rate of return, that's a nice investment strategy to consider. You don't have the upside, but you don't have the downside either. In the middle, which is kind of our fairway that we're known for, is what we call our income strategy. Now, this is actually where you're investing in your cash into like Roland said, a limited partnership. You're a limited partner, and we were pooling capital of other investors into a fund to then go out and aggregate and put a portfolio of minerals together that have hundreds, if not thousands, of wells in them across the country. And those funds are going to generate cash flow immediately. So we're looking to buy assets that already have producing wells on them. So that risk has been taken out. They've been de-risked. And then we underwrite and engineer what do we think the future value is. So those assets have cash on cash returns ranging between 10% all the way up to sometimes 30, 35% cash on cash on an annual basis. We've averaged since 2019, 16%. That's through COVID times when oil went almost down. It never went negative. We never saw negative check stubs where the operator was basically invoicing us for production, but we did see it get pretty low. So it just kind of speaks to what that cash on cash return looks like. And then the third kind of bucket that we look at is what we call our growth strategy. And that's the investment in the direct drilling deals. That's, higher return profile. There is more risk, right? Because you're investing in oil and gas, the drilling of oil and gas wells, and you get that massive write-off. So happy to unpack any of those three. Again, we really focus on that income strategy as a good foundation for people if they want to kind of get in and kind of test it out. You'll get monthly distributions. We do quarterly newsletters. You get K1s, before the April 15th deadline. We've always been good on that. So happy to go wherever you want on those three types of strategies.
Roland.
Yeah, I mean, I think the fixed return is pretty easy for people to understand, and maybe like the income strategy. You said it's a diversified portfolio or basket of multiple assets, and so is that a really a continuous deal, or do you have a term for the fund?
There are terms. What we do is we open a fund up, and investors that invest immediately, we pay an 8% preferred rate of return until the fund closes. Okay, and as soon as it closes, then we know who all's in. We know exactly how the investor deck's going to look as far as distribution percentages. We'll pay that 8% first, and then we'll start doing the distributions as soon as royalty income comes in. And so that strategy, that income strategy, we're looking at a 1.5 to 2 to 1 MOIC, multiple on invested capital. So if you put 100,000 in, we're looking for 150 to $200,000 back. That's including the royalty revenue distributions each month, and then ultimately we're looking to sell within a, call it 3 to 4 year window. Internal rates of return shooting at 18 to 22% is what we're targeting for that strategy.
So just, I remember when we discussed this episode earlier, Jace, that you had mentioned that if I'm correct, there's just you have lots of opportunities for assets to acquire for this fund or other funds like this right now, that you've developed your underwriting strategy for sussing out those kinds of assets, and that it's perhaps one reason that you're able to keep doing new ones or rolling over new ones. Am I remembering that correctly?
Sir, exactly right. We've got an in-house acquisition team.
Hmm.
It's very skilled in just understanding sales pipeline, sales process, connecting with sellers, working with the sellers over time. Not just we try to do more pull, less push. If it's
Hmm.
an option, we try to be transparent with our underwriting so that they can make an educated decision. We think that's important. So building that rapport on the front end. But yeah,
Hmm.
our pipeline is extremely full. What we found is, I mean, listen, there's nothing sexy about what we're doing. I mean, it's hard, ground game. It's not easy. We're picking up a lot of frogs and kissing them to see what we can find. And it's, direct mail. It's heavy cold calling. It's reaching out into networks and finding people that may be interested in entertaining an offer on their mineral estate. And we can do that fairly quickly if they want. If they want to, space that out, we can do that as well. So
Hmm.
I'd say right now, pipeline, I was talking to Adam Lapucci, who's our director of royalties. He said over the next 12 months, we could probably deploy up to 100 million based on our current strategy alone. So we've got quite a bit of pipeline that right now, if it fits the buy box for one of our income funds, we'll do that. If not, then we'll look to divest and do a quick maybe flip out to some bigger private equity type buyers.
That's really exciting, Jace.
Yeah, really it is. Just one other quick point was, I guess the tax, you've got these three different strategies, and obviously the tax impact or the tax benefits from them would vary in accordance with what kind of strategy that you would elect, which is also, I guess, part of what's appealing. I mean, it's just quite amazing. To me, it's quite amazing the breadth of what you can offer to people.
So the most aggressive tax benefits is kind of in the highest risk category. It's in that third bucket where you were describing the direct investment in working interest, right? Is that how you would
Correct.
describe that?
Yeah,
That's
that makes
absolutely
sense.
correct. And we're looking, in those deals, we're looking at really curating a good direct drilling deal with, people that we know and trust that on the operator side. In that return profile, we're looking at, I don't want to participate in direct drilling deals unless I have an opportunity to hit a 3 to 4 to 1 MOIC. Internal rates of return 40+%. And so
Wow.
that's what we're trying to look for that strategy. There is inherent risk with that, right? You can put your money in and there's dry holes that occur. Obviously that's not why you want to invest, it's just for the taxes. But we really try to curate good opportunities. It's a small circle in our industry that we kind of work with and to try to find those types of opportunities. We'll probably do one, maybe two of those a year. And they're kind of sidecar. They'll come up. They usually kind of come up towards the back half of the year when people are starting to kind of think about, hey, I had a good year. I want to figure out a way to kind of offset some tax. And so that's kind of when we're trying to look to bring those to market.
Well, that's good. So that I think that gives us a really good overview, and then what we wanted to move on to is a discussion about self-directed retirement accounts, and we're talking about investment in these private securities. Of course, there are opportunities to invest in public securities in the energy space, but these are private investments, and we've talked about that before, what that means. But I think, and this just comes up over and over again with our clients, that it is a surprise to many investors that they can actually use their retirement account fund. So either through an individual retirement account, an IRA, or a 401k plan, you can use those funds to invest in private deals. There's some requirements about that. But Jace, yeah, tell us about how you talk with people about that, how you advise people about investing through their self-directed retirement accounts.
Yeah, well, I think the self-directed IRA investing into that income strategy is ideal. I'd say about 20% of our investors in that strategy are coming from self-directed IRA. And so, as you mentioned, having a self-directed IRA, you're able to allocate and invest in more what you want to invest in versus maybe a mutual fund that a larger institution is trying to put you in. So you can look at these types of assets to invest in. I think it's a great diversification. Obviously, it grows tax free, which is great. So we've got quite a bit of investors. We work with several self-directed IRA custodians throughout the country. There's a little bit of we've got to provide the documentation. There's some forms to fill out. So there's a few extra little steps as far as the subscription, but our investor relations team does a phenomenal job of working with the custodians, and then they obviously transfer the money from the self-directed IRA account into our separated partnership account, and then distributions go back into that self-directed IRA.
You want to give a shout out to any administrator that you find particularly easy to work with and cost effective?
Absolutely. Horizon Trust is our favorite. Greg Herline, who runs Horizon Trust, is a phenomenal operator, astute businessman, and their level of service is phenomenal. So I'd highly recommend Horizon Trust.
Okay, that's helpful for sure.
Yeah, thank you.
Mm-hmm.
So you know what, Jace, we could talk about all of this more. Roland, do you want to flesh it out anymore, or should we move on?
Well, I think it's really useful for people to understand that with the income strategy like that, it's great. That's how the IRA, a tax deferred deal. If you invested in that through your taxable funds, then you're going to have to be reporting that income. But that's the advantage of the tax deferred retirement account. So I would really recommend people get in touch with understanding those, and as part of any kind of, financial plan that you work out, you always want to take advantage of the opportunities to save on taxes through the making contributions, and there are limits on, what you can contribute. But I think a lot of times people will forget about those, or maybe you'll be employed for a long time at an employer and your only investment option was to invest in public companies, stocks. And so you did your allocations like we do through the law firms there. You do your allocations to those different funds that are available. But then if you leave that employer, you're going to have to roll it over into an IRA most likely. And then in that rollover process, just selecting an administrator like Jace told us about Horizon that will allow you to invest in private assets. I mean, I think that's the question that our audience members should ask the administrator is, just that self-directed concept. Make sure that your administrator, allows for self-directed investments. Jace, did I miss anything?
No, that's where, I think the biggest area that people often forget about is, like you mentioned, I was working for a company for 10 years. I'm no longer there. I've got a 401k. It's no longer hinged to their plan, and it's just sitting there. And that's a perfect example where the group over at Horizon Trust could work on converting that over into a self-directed IRA to then be able to then look at directly investing into alternative investments such as oil and gas minerals.
Jace, I was just thinking, something we didn't mention before that might be interesting to viewers is because you have these different options, and of course we'll put your contact details down below the video, so I assume people can contact you and ask questions if people are interested. But generally, what's your typical buy-in in one of your funds? Do you have a pretty high minimum threshold? We see everything from 25,000 all the way to $1 million being a minimum buy-in, depending on the situation.
Yeah, we do. It's a $50,000 minimum. So we think we're right there where you need to be.
Yeah.
But yeah, and we have a little bit kind of the promote structure. If people invest over $250,000, it's less of a promote on the back end. And our biggest, I'll add to that, how we're compensated. It's kind of it's a way my home man did it. It's called a back end after payout. It's kind of an old school oil and gas setup where investors earn all their money back, and then after they get all their money back, then we as a sponsor back in after that, not on the front. It's not an 80-20. Once we eclipse a certain threshold, we're really committed to getting all of our investors their money back as quick as possible, because that's when we come in and start to earn our promote. So yeah, if it's over 250,000, it's a little bit less than if it's under 250. But again, it's all very, very reasonable.
That completely tracks with what we experience with our clients with the varying degrees of kinds of deals that they're promoting or offering or what people might be investing in. So, and it's actually great because then if you're new to all of this, and you have $50,000 that's, especially if you're an accredited investor that, you want to give a new asset class a try, then, you can go in more if you want to, but sometimes people need to try bite-sized pieces, right? So while they get comfortable with different kinds of investment strategies. So, but in any event, I think what you're doing again, Roland, we talk about with commercial real estate, how in the end, there's always something underpinning some kind of a real estate asset, some kind of a real property that's there. And, mineral estates for the most part are a pretty sure thing in the places, where that's a normal part of, the property that people own. And so it seems like it's a really important area not to forget about, especially when you're maybe culturally or from a part of the country where, you don't immediately think of the energy industry.
Yeah, sure. I mean, we live here in Austin, and there's not a lot of activity here, but man, we just drive a couple hours outside of Austin in almost any direction. You'll see, the jacks, pump jacks.
Exactly. Like I grew up mostly in Dallas. And so, of course, driving anywhere from Dallas, especially west, but east, it could be anywhere. I guess historically, the oil industry, it first started in Pennsylvania technically, but then actually it was Eastern Texas where things really got going as the original founder of this new industry called oil and gas. That was, I guess, over a century ago now. But from what I've read, that was,
HL Hunt.
Huh?
HL Hunt.
I know it's funny because where I grew up, one of their family houses was kind of down the street from us, and so we grew up with the sort of the hunt, the myth or the reality, the story of the hunts, kind of like because we drove by their house on the way to school. So anyway.
But I just think, not to be repetitive, but hearkening back to that earlier time, and there was just such this view. I mean, wildcatter is a term, and just in my mind, there was so much risk associated with this. But I really, and there are no guarantees of anything. But somebody described oil and gas more as mining now, rather than wildcatting. Or just you drill a hole and hoe. With these new technologies, there really is a lot more certainty. So that's what really intrigues me about these investment opportunities we're talking about.
Yeah, let me add to that. So what you're speaking to is what we call conventional drilling. This was the whole, vertical wells. They would be finding little pockets that had a lot of pressure, and they would poke around, and you could be 100 feet off and out of it, and 100 feet over, you're in it. And that still goes on today. Don't get me wrong. I mean, that's my dad built a career around that. He had more wins than losses, but he definitely had his fair share of dry holes. It just goes with the territory. With the horizontal drilling into shale plays in the Permian, in the Haynesville, in the Barnett, in the Marcellus, in the Utica, you've got these like homogeneous shale plays, right, that are blanketed in these regions. And it's literally, like you said, you're just layering in these horizontals. So this dry hole risk in these horizontal shale plays, especially in these tier 1, tier 2 areas where it's there. It's not like you're guessing. You can see it. It's everywhere around you. That high risk piece has really been taken out in it's called unconventional drilling. And so that's been the biggest change. Whereas the wildcatters of yesterday, they're kind of hard to find. They're doing crazy stuff like trying to find heavy oil in Missouri. And by the way, we did that. I did that with my dad, believe it or not. So there still are wildcatters out there. They're just really hard to find.
Jace, I don't know if we talked about it, but I spent basically the last 20 years living in the Gulf and the United Arab Emirates. And of course, being the Gulf and Saudi Arabia is right there. And also Abu Dhabi is a gigantic producer of natural gas. You hear about, and the price of oil actually dictates everything in those economies. But what's interesting, I think, for here is just to note to our viewers is that in most places in the world, perhaps all other places but the United States and Canada, you don't have private ownership of mineral assets. the government owns them
Right.
and disperses the benefits as it sees fit, really. It might be that there are pockets of private ownership in some parts of the world. I mean, the Nordic countries perhaps, but their government, I mean, on the back of oil and gas, some of those largest sovereign wealth funds in the world are based on the oil and gas reserves that are in the North Sea. And those, the Scandinavian countries all benefit from that and people from those countries. So I don't know if you have any observations or just ponderings about this topic, but this whole idea that private individuals can invest in and benefit from the oil and gas industry is something that's pretty unique to the United States, I think.
Very unique. I mean, there's some small pockets in Canada, like you mentioned. I'm not as familiar with the Nordic countries, but yeah, the United States is the only place where surface owner could own the minerals, and a lot of times it's been cut up, and you can also reserve them. So the oil and gas minerals, when we talk about, they say from the center of the earth to the zenith of the sky, all right, title and interest as far as owning real estate, right? All the bundles of sticks, oil and gas, and the mineral interest are part of those bundles of sticks that go along with the real estate. And so, yeah, it's a unique opportunity. But imagine, from the first person that was patented from that president back in 1850, and then he transfers it to his family and people. So you can imagine how it all gets broken out over the years. And that's what, landmen do, is go out and kind of piece that together, because there's no title policy for this kind of stuff. Where you go to a title company and they'll give you a title policy. I mean, you got to know your stuff. We got to run the title ourselves and make sure that we agree with who owns what. But it's made many families very wealthy. I think I heard that, out in West Texas, the ranchers are really they're oil men that just have cattle because of the oil, because they've made a lot of money out in the Permian owning land in the right spot.
That's great. We like to take a step back and look at the structural advantages, the laws that are implemented. We talked about the securities laws previously, and then, this private ownership of mineral rights. It's really combining that with capitalism. Whatever your political leanings are, you have to appreciate that, the United States achieving energy independence and now becoming the world's biggest hydrocarbon producer, that's really significant. It gives us, it's a blessing for our country, so to speak. Whatever you think about the future, and probably we will see more electric roads electric cars on the road, but just like you said, Jace, our infrastructure is so oriented around hydrocarbons that it's not going away at any time. And I think
let's talk. I mean, because that's definitely a big point that comes up when people ask me all the time is, hey, where's the future of this stuff? What's going on? I mean, with all these Teslas and EVs and all, I mean, you got to go all the way back to the source and really think through this. Like, what charges the battery? Where's that charge? Right? And so you got to think about that. And so the way I look at it is that coal was the energy source of the past. Oil is the energy source today. Natural gas is the future. We are the Saudi Arabia of natural gas. We've got more natural gas reserves throughout our country than any country anywhere in the world. And so what you're seeing is coal-fired plants converting into natural gas-fired plants. So more demand on natural gas. You're also seeing LNG, liquefied natural gas, especially along, the Gulf Coast, starting, exporting out to other countries that don't have that need that. So they're liquefying natural gas to like negative, you name it, to get it frozen and then put it on a tanker and send it overseas. And even something that's come up, and I'm hearing in a lot of the oil and gas conferences that I go to within the last year, are these AI data centers and how much demand they put on the grid for energy and electricity. And so, we're looking at a project of drilling natural gas wells that feed right into AI data centers on the same location. So there's going to be a lot of demand and just the infrastructure alone, for the foreseeable future. So,
well, the crypto mining too. I've heard about natural gas powered crypto mining operations.
Exactly.
Yeah, I think all of that fits in West Texas. So I think I read an article about it. You don't need cattle anymore if you can put a little mining facility on there, crypto mining facility.
Yeah, or AI data center. The AI is really, the big one that's starting to drive.
It's really, yeah, it's super power intensive, right?
Absolutely.
Yeah. I think Texas already has the crypto mining facilities. I saw a few articles about that recently. So why not? It's suited for it in terms of space. But anyway,
Well, hey,
well,
Jace,
go
before we
ahead.
move on, I know that the next topic, sorry to interrupt, sir, but the next, or what we wanted to kind of wind up with is a discussion about the 1031 exchanges. But anything else from, your business standpoint, anything that we haven't told our viewers about that you would want to, make sure that everybody knows?
No, I mean, I think we've covered, most all of it. Again, just kind of, our strategy, what we do is we go in, we're talking to mineral owners throughout the country. We are seeing if there's a motivation to sell. If there is, then we're really going tight and underwriting those types of opportunities with our in-house engineering team to then make solid offers. And so, we believe in that approach versus going in and underwriting a certain basin and saying specific to a certain part of a basin. We want to figure out, do we have a interested seller that we could get a value add position on the purchase with a lump sum payout? So, we've got funds in play throughout the year. We're wrapping up a fund right now called Maroon Bells. You can check it out at maroonbellsfund.com. I started naming these funds after 14ers I climbed in Colorado. I got tired of fund one,
Cool.
two, three, and four. So the next fund rolling out is La Plata Peak in 2025. But I need to, I think I need to go climb some more 14ers and running out of names.
There are a lot of those down up in the San Juan Mountains, aren't
There
there, in
are, there
Colorado?
are. But I want
Yeah.
to only climb the ones that I may not fall off and
Yeah.
do some
I've only done
premature
one of
ones.
them.
I need
I
some
don't even
tough ones.
remember its name.
Yeah. So
Okay, well, this is setting us up. One of the things that we wanted to talk about is 1031 exchanges, and we haven't talked about this a lot or at all yet, but it's really fundamental in this area because it pertains to investments primarily in real estate. And Section 1031 is a provision from the Internal Revenue Code that allows you to sell a piece of real estate, and then provided that you roll the proceeds of that into another piece of real estate, or conduct a like kind exchange, sorry, then you won't recognize, you won't be required to recognize the tax on the sale of that first property. And it's just really a provision that's been in the Internal Revenue Code for a long time to encourage real estate investment, essentially. But Jace, tell us maybe about how this comes up in your the investors that come into your deals.
absolutely. We do have quite a few investors that invest in our funds, but also, have a 1031 exchange event going on primarily with real estate, selling commercial real estate, selling multifamily, whatever it may be, and are looking for options. And they either come to us, in advance. Hey, I'm looking to sell. Do you have anything out there? Obviously, we've got a big pipeline, as I mentioned earlier, but we also have assets under management just sitting on the shelf, ready to go. That could be a fit. So we talk to those investors. We try to figure out a little bit of what is the strategy? Is it more buy and hold, or are they going to be looking to maybe sell this asset in the next 2 to 3 years? Because the biggest difference between the 1031 exchange and our income funds is the 1031 exchange is you're going to be invested in a certain asset or maybe a couple of assets versus a blended portfolio. So we really want to get you educated on what that asset looks like. And so we do all the engineering and the underwriting. We then provide a lot of here's where we think, here's what's going on, here's how we see the trend, and really getting our investors educated on what we think the overall return profile looks like conservatively. And then, then they can designate that as a 1031 exchange. And we work with a lot of those custodians as well, kind of facilitating, the naming of the asset. And remember, you got 45 days to identify and 180 days to close. So sometimes we get people calling in at the last minute. They couldn't find real estate and they want a 1031 exchange, and it's sitting there and they're on the 43rd day. We can help with that. Like I
Oh,
said, we got
wow.
assets sitting on the shelf. We can just carve those out and say you got 200,000 in 1031, a million in 1031. Let's kind of put something together that fits your investment profile, whether that's cash on cash yield now or long term upside.
Yeah, and let's just point out one thing that a lot of times clients will come to us and they prepared a pitch deck on a syndication of a real estate deal, and there'll be a line in there that says 1031 eligible, and just trying to attract people with 1031 funds to invest in the security syndication. But it's important to note there, immediately we have to dispel the idea that you can use 1031 and that way 1031 funds. The important point to note is if you sell the real estate and you have funds that you want to qualify for 1031, you can't invest in securities. You can't invest in a syndication in an LLC interest. So, Jace, how do you structure your investment so that people are eligible to use their 1031 funds?
Great question. Exactly. So it's a little bit different than the mineral funds, right? How we structure that is we do a kind of what we call a promoter, a carry on the front end, because you own the assets free and clear. You're getting the check stubs. So we kind of work with those investors depending, and usually it's about an eighth carry on the front. So about a 12.5%. So investors putting up 100% of the costs and getting 87.5% of the interest. And we factor that into the economics to make sure it makes sense. And if it doesn't, then we adjust accordingly. But we also, a lot of times investors are like, okay, I'm getting these check stubs, but what's going on? I mean, these things are very detailed. There's marketing costs and deducts. And so we also are opening up a mineral management component of our business in 2025 to kind of work with those investors to say, hey, listen, we'll continue to manage it just like we do our mineral funds, and you'll get a monthly update of activity and making sure that you're being paid properly if that's something that the investor wants. And then the last piece is if they want to go on and sell and divest and maybe 1031 exchange back into real estate, we can help with that as well because, we know, who the buyers are for that particular asset.
And do you have a 1031 company that you like to use or could recommend?
I do. IPX Exchange. Craig Brown he's the guru of 1031 exchange on the oil and gas front. He's out of Dallas, Texas. Craig Brown at IPX Exchange.
And just full disclosure, we have a law partner. We're going to have them on as a guest. They've got their own 1031 exchange company as well, and he can tell us more about that. But there's lots of different opportunities to use those services out there, and so we do want to give opportunity for people to let us know about the service providers that they feel confident in. That makes a really big difference rather than just going, doing a Google search and looking for a 1031 company.
I think particularly if you're already interested in the oil and gas asset, it sounds like, Jace, I would assume that, the Craig is experienced with your kinds of deals and your kinds of, and the oil and gas options available for 1031 exchanges. So it's also good, Roland, isn't it, to hear about some of these other people who might be the right person for the right investor in the right alternative investment.
That's right. There's the one thing in this business, there's no one size fits all. Everybody's circumstances are unique, and that's what makes it interesting. You have to account for everybody's own unique tax circumstances, their life circumstances, and
and that actually, Jace, just so you know, something that Roland and I have talked about not at length, but we try and briefly mention every episode, is that alternative investments are a wonderful space. They're a great place to invest, but you have to focus on your self-education, and also you need to rely on the right advisors. If you're a person who's more comfortable with the sort of passive stance you can take through the public equity markets and the variations of ways that you can invest on that side of things, that's great. But once you move into this space, you need to be a little bit active just so you can, always understand and, read the private placement memorandums for the funds you might be investing in and all of those kinds of things. And for a lot of people, I would imagine that's rewarding to really start to understand more about the different kinds of alternative assets that are there and the ways to invest in them. And there's a sort of self-empowerment that comes from it, from not becoming an expert necessarily, but starting to understand how this asset class as a whole has so much to offer.
Yeah, and I'll add to that. We try to. I totally agree. And sometimes reading these PPMs and trying to understand the nature of the business, it all sounds good. You like the story, like everything looks good, but how do I know? We've kind of proactively reached out to. There's a firm out in Nebraska called MIC Law, MICK Law, and what they do is they will go in and do a third party underwriting of your private placement. And we've started doing that as of our last fund, and we'll do that all funds going forward. And this is like what the wealth management companies, the RIAs out there are looking for, because again, they need something to be able to validate, like, is everything that Jace is saying correct? Like, and they go in and they verify all of our distributions, and they go out, the return profiles that we're saying, is that correct? The engineering reports, are those valid? And they do third party engineering. So we try to take a proactive stance at Rising Phoenix Capital to get those types of things in place so that it helps investors look at that, kind of step back, not just coming from us, but also from a third party to kind of see, is this worth investing in?
That's great. It sounds like you've got a lot of best practices implemented, and so it's good to learn about.
Yeah. Just to conclude things, one thing that we were gonna, apart from if there are any other topics that you still want to discuss, Jace, but one thing when we were first conversing last week or a couple weeks ago that I found really, really interesting was the way you talked about your personal planning, and you have such a positive attitude about how you plan for the future, how you run your organization, your family office, et cetera. You'd even mentioned that you and your wife like took a couple of days out of everything to just go and touch base about your personal goals, I assume, and maybe the business goals also. So would you like to share any of that for us? Because you've got this personal and organizational philosophy approach that just seems really positive and proactive.
No, that's great. I mean, we talk about, life, right? At Rising Phoenix Capital. Career is one. We talk about the wheel of life. We did a big talk yesterday about it, where we're doing a lot of big goal setting with our team for 2025. And so we take that very seriously. The wheel of life talks about the different aspects of life, from spirituality to career to relationship to fun and recreation to health, you name it. And so what we do is we really want to kind of focus in on, let's put some real goals out there, and then let's hold each other accountable. And so we do a wheel of life kind of evaluation. Each person on our team does that. And then that steps out into career with a 1-3-5 plan, where it's like, what's the one thing that you want to crush in 2025 from the career perspective? What are the 3 kind of strategies, whether that's networking or health or whatnot? And then what are the 5 very actionable, smart, tangible goals that you can set to hit that 3, to hit that 1? And so we're very, we move with intent. We met as a leadership team down in Austin for 2 days, and we planned 2025. I mean, the roadmap is there. And so now we've got, the 10-year target, the 3-year, the 1 year, and even the 90 days. So my leadership team, I mean, we've got some, we're stepping through that. But you're right. My wife and I went and did a little couples retreat where we planned all of 25 with vacations. So we put all the vacations out there, and any of the events that I'd be going to that kind of helped me learn more about just, things and our businesses and whatnot. So we did that whole thing. And then I'm going to do a little solo retreat next week where I'm kind of really refining my wheel of life and really trying to figure out what goals do I want to try to achieve in 2025. So I think that's important. Career is one piece. Making money is one piece. It's not the end all be all. So I think you need to take stock.
Just want to tell you something. We, if you're interested, we're just put out an episode with a friend of ours he's also an attorney, but he's an estate planning attorney, and he does qualitative estate planning. And the wheel of life and what you're talking about in terms of how you organize your life, there's a whole way of thinking about your wealth, your financial wealth, your spiritual wealth, your social wealth, your intellectual wealth, all of these things that roughly fit in with, I think you just said, that he advises his clients on, who are working on passing everything that they've created in this life or inherited on to future generations, with a view to having it last for up to 7 generations, like not just what's the next generation.
Right. Love that.
And how family health and human health and all these things balance that you're talking about are such critical factors of all of that. That's David Cloughlin, who's our friend and colleague. He's not our law firm colleague, but he's, a member of the bar. And so in any event, I think there are different ways to look at going about doing that. And it's just, it seems like it's more and more of a theme for people, and such an important theme too, because in the end, it's very easy to get out of balance in one's life. And so seems like really good successes can come when you take care of all the parts of the wheel of life, or all the parts of your capital and your wealth.
Yeah, no, this is from 2024.
Oh, cool.
And so, we don't just talk about it, we do it. And I started looking through all the goals that I set for 2024, and I damn near hit 75% of them.
Oh, that's cool. I've done one of those before. Yeah, I need to. You're inspiring me to get back to it.
It's impactful. When you put pen to paper and you set these things up, and you start manifesting, it's a powerful thing. So we're big on that. We've got, we're very transparent at Rising Phoenix Capital, transparent books. The team's all aware. They know what the P&Ls look like. So that's just kind of how we want to live life. Same thing with my kids. We're starting to bring them in. They're 8 and 11. We're starting to bring them into that kind of the education of just what the family looks like from a net worth perspective. And so really communicating all the way down, just like you said, Sarah, thinking that legacy. I didn't think 7 generations out. I was thinking like all the way down to maybe G3, but I think it's important.
No, as far as you think you can go, but I totally agree with you on kids. I think in the past, kids were considered protected if they weren't included in family financial things, financial discussions, maybe successes financially, but also some of the, worries maybe. And so we do the same with our kids. Like, of course you can understand money. You need to understand the value of money and how you get it. It doesn't just sort of arrive on the credit card, right? At Amazon.
You talk about the value. We teach our kids to create value.
Yeah,
right?
Exactly.
Create value. And so we've got, we've kind of started this. It's kind of in process right now, but where we got a gig board where if they want to go make money, there's things up there where they create value. And if they're valued, then they get paid. And so if they want to go out and from a thank you note, $1 to walk the dog, $2, and so we've got this gig board that we're kind of working on, and it's getting bigger and bigger, with their input, where they're thinking value first.
Yeah, no, being a producer, right?
Yeah.
Having something to contribute to.
Same thing for us. If we create value, we're thinking in dollars, right? So
but Roland and I, that's part of our philosophy for how we approach our clients. It's part of what caused us to form this webcast, actually, was wanting to try to create more value for clients in terms of giving them a place to talk about the deals they're promoting, or, if they're interested in investing in things. And also we've had, it's a great opportunity to learn. So listen, thank you so much for joining us.
Absolutely.
Roland, do you?
Yeah, for sure, Jace. Thank you so much. And I think that this seems to be kind of a natural place for us to stop.
Yeah,
and I think we've addressed a topic here today that is real useful knowledge for investors and for other people that may be interested in the oil and gas business, but primarily we're speaking to investors, and we hope that it's given our audience some good food for thought when they want to consider diversifying your portfolio, specifically in oil and gas. So again, Jace, thank you so much.
Thank you guys for having me on.
Yeah, it's so lovely to meet you, Jace, and so informative. I can't wait to actually keep learning more. I might check out your website. So just thanks everyone for joining us today. If you like this episode, please like and subscribe to our channel.
And remember, everyone, take aim with your alternative investing strategies.
See you next time.